Now speaking, Tyler Burns, Director, Investor Relations. Canopy Growth released its financial results for the fourth quarter and fiscal year ended March 31, 2023. The company filed a comprehensive annual report on Form 10-K for the fiscal years ended March 31, 2023 and 2022, which contains audited financial statements for the fiscal year ended March 31, 2023 and restatements of previously filed periods. Canopy Growth's Chief Executive Officer, David Klein, and Chief Financial Officer, Judy Hong, will provide their prepared remarks before conducting a question-and-answer session. All financial information is provided in Canadian dollars. Now speaking, David Klein, Chief Executive Officer. Fiscal 23 was a year of transformation for Canopy, marked by a full divestiture of their national retail operations, exiting cultivation in Mirabel and Smiths Falls, moving post-harvest manufacturing to their former beverage building in Smiths Falls, adopting a flexible third-party sourcing model for cannabis beverages, edibles, vapes, and extracts, and reducing headcount. SG&A expenses and COGS delivered a combined $125 million through the end of fiscal 23, and they expect to reduce overall costs by $240 million to $310 million in total by the end of fiscal 24. They launched an internal review into their BioSteel business unit, resulting in several remedial actions to strengthen their controls and considering all legal remedies available to them, including litigation to recover damages and costs associated with and resulting from the findings of the BioSteel review. Despite this, BioSteel saw a 101% revenue increase in fiscal 23 and growth in ACV in the U.S. market. For their Canadian cannabis business, they saw a slight increase in adult use B2B revenue in the fourth quarter of fiscal 23, driven by the strong resurgence of the Tweed brand. In late May, they announced control of distribution, marketing, and sales of Wana products in Canada. To gain exposure to the U.S. cannabis market, they filed a revised proxy statement with the SEC in the current quarter, which outlines revisions to the structure of their interest in Canopy USA. Their priorities for fiscal 24 include prudently managing expenses to deliver a stable to growing top line with their Canadian cannabis business, driving insured patient registrations with their medical side, increasing the consistency of supply of high-THC flower strains and the sales of new products with their international medical cannabis business, and expanding their North American market position with their BioSteel business. Now speaking, Judy Hong, Chief Financial Officer. As of March 31, 2023, the company had $783 million in cash and short-term investments and total debt of $1.3 billion, of which $557 million was classified as current portion of the long-term debt. The company took a number of additional actions to strengthen their balance sheet, including paying down $93.75 million of their term loan at a 7% discount, refinancing $100 million of the 4.25% unsecured July 2023 notes held by a subsidiary of Constellation, and settling the $100 million related to the February 2023 convertible debentures through equity. Fourth quarter net revenue was $87.5 million and full-year fiscal 2023 revenue was $403 million, with adjusted EBITDA loss of $96 million during Q4 FY 2023 and $350 million on a full-year basis. SG&A expenses, excluding acquisition costs and depreciation and amortization expenses, declined 3% on a full-year basis, and free cash flow of a negative $143 million was a 13% increase in outflow compared to Q4 of fiscal 2022. In Canada Cannabis, the speaker reported that revenue declined 8%, excluding the retail business divested during Q3 of fiscal 23, but adult use B2B sales increased slightly compared to Q3 and medical sales increased 8%. Rest of the world cannabis segment, excluding C3 divestiture, was down 19%. In stores and Bickle, revenue declined by 28% in Q4 fiscal 23 versus Q4 fiscal 22, but full-year gross margins remained resilient at 40%. This Works revenues decreased 10% in the current period compared to the prior year due to challenging UK retail dynamics, but adjusted gross margins improved to 44%. BioSteel generated net revenue of $19.3 million in full-year fiscal 2023 revenue of $69.6 million. Q4 gross margins were significantly impacted by lower than forecasted sales during fiscal 23, as well as their decisions to exit international businesses and refine their U.S. commercial strategy. The speaker noted that addressing its cost structure is an important part of Canopy's overall profitability plan, and they are executing on cost reduction initiatives and right-sizing their marketing spend. The company expects to approach positive adjusted EBITDA across all of their businesses, except for BioSteel, as they exit fiscal 2024. They also expect BioSteel to show meaningful reduction in its adjusted EBITDA losses in fiscal 2024 while they work to strengthen their balance sheet and drive continued focus on their core cannabis business. BMO Capital Markets analyst Tammy Chen inquired, "What is the EBITDA target of this company for the end of fiscal 24 and what can you share about the P&L of the cannabis segment in Canada?" Judy Hong replied, "Thanks, Tammy. Our P&L can be challenging to understand at times, and we're working on ways to provide more clarity going forward. To answer your question about Canada, we've taken significant action to right-size our operations and SG&A costs to be profitable at a 35 to 40 million quarterly revenue run rate. We've reduced headcount, closed facilities, and exited cultivation at Smiths Falls. This should result in improved cash gross margin closer to the high 30%, as well as cost savings in sales/marketing and G&A." Cohen & Company analyst Vivian Azer inquired, "Judy, can you speak to the path to profitability for BioSteel and how the realignment of marketing and retail channels in the U.S. may affect the top line?" Judy Hong replied, "Vivian, thank you for your question. We understand that BioSteel is a drain on our overall profitability and we are actively working to reduce our cash burn in the business. In FY23 there were inventory write-downs and increased contract manufacturing costs which won't be recurring in FY24. We have initiatives in place to right-size our marketing spend and optimize our cost structure to support the brand, which should lead to reduced cash burn and improved adjusted EBITDA." David Klein replied, "I think in terms of our channel strategy for BioSteel, the issues we outlined are unfortunate, but it's important to note that the brand continues to be well received by consumers, up 101% year over year. We believe that the same approach we took in Canada should be implemented in the US, where we build an authentic connection with consumers before entering major retailers. We're confident that going direct into those retailers without building the base across the entire US would have been too ambitious for a company our size. Therefore, we've decided to take a step back and focus on growing the brand through a more targeted approach." Alliance Global Partners analyst Aaron Gray inquired, "What financing options are available to Canopy USA once the NASDAQ listing closes?" David Klein replied, "I want to reiterate that both businesses are actively working together to enhance their operations and routes to market. On the day of closing, the business will have more than enough cash to fund foreseeable growth initiatives. Should we decide to pursue any inorganic strategies with Canopy USA, we have the ability to do so using the existing structure." Judy Hong replied, "Aaron, the benefit of having a brand-led, asset-light model in the US is that it minimizes the capital needed to build up the business significantly. This same strategy has been applied in Canada and is important for people to understand why. The goal is to ensure minimal capital investment needed to establish a robust presence at scale." David Klein replied, "Wana and Jetty have both achieved success by being asset-light. This approach has allowed them to build their brand and maintain a favorable profit and loss statement. Acreage requires more capital investment, but our long-term goal is to be as asset-light in the US as we are in Canada." CIBC World Markets analyst John Zamparo inquired, "Given the current state of the balance sheet, what are your plans to issue more equity in order to close the gap to positive EBITDA? Are you considering selling any business units outright?" Judy Hong replied, "Yes, John. Thanks for the question. We ended Q4 with a cash balance of $783 million and expect up to $150 million in proceeds by September 2023 from facility dispositions. We anticipate significant operating cost savings too. We're positioning ourselves as a cannabis-focused company, which may include divesting non-core assets and businesses. Plus, we plan to reduce our debt accretively, partly through proceeds from divestitures that will be used to pay off our term loan, resulting in lower interest expenses." Piper Sandler analyst Michael Lavery inquired, "Can you provide us with insights into the liquidity management strategy for this year, particularly with regards to divestitures and facility sales? How are those valued and what is the certainty of them coming through?" Judy Hong replied, "To answer your question, we are expecting to see a significant reduction in our operating cash outflow and a reduction of approximately 50% year over year. We've implemented cost-saving initiatives that will also lead to a reduction in interest expenses by $20+ million in working capital improvements. Our capex requirement is minimal with expected costs between $10 to $15 million. In addition to these measures, we are exploring additional options for liquidity." Canaccord Genuity analyst Matt Bottomley inquired, "What were the issues with the restatements that caused BioSteel's revenues to be reduced by 20%? Judy Hong replied, "I can confirm that the majority of restatements in our earnings call were due to international sales. Our market share data in North America is genuine and reflects the strength of the BioSteel brand. The misstatements we encountered were due to an opportunistic attempt to expand distribution in certain foreign markets with existing inventory. Though this has masked some of the positive momentum in our business, we remain confident in the trajectory of the brand." David Klein replied, "As I mentioned in our remarks, the restatements were primarily due to sales practices within the BioSteel team. These have been addressed and corrected, so there is no need for worry." Zuanic and Associates analyst Pablo Zuanic inquired, "David, what are the benefits of Canopy USA for the company? What alignment has been achieved between Jetty, Wana and Acreage that could not have been done without the transaction? How will these US assets be disclosed in the future? How has Canopy USA affected your main competitor in Canada and your operations in Europe? David Klein replied, "We believe our brand-led approach in the US market is strong. Jetty, Wana and Acreage are already working together, and we expect significant synergies from merging them together into Canopy USA. We're focused on North America to create value in the medium term." RBC Capital Markets analyst Douglas Meem inquired, "What checks and balances are in place to ensure that unforeseen issues are avoided?" David Klein replied, "Doug, our remediation plan for BioSteel was thorough and included forensic accountants, outside legal experts, our finance team, and the guidance of our audit committee. We tested to make sure that these issues weren't being replicated elsewhere, and thankfully, they were not. We are committed to having a robust control environment and have taken the necessary actions to ensure that we do not have similar issues moving forward. A restatement like this is embarrassing, but we are confident in our remediation plans." David Klein replied, "Thank you. We've made significant progress this past fiscal year, completing the BioSteel review and introducing our Canopy USA strategy. This fiscal 24 strategy is designed to drive growth of the brand in North America while reducing cash burn. We're also expecting to conclude the regulatory review for Canopy USA and move forward to a shareholder vote in the coming months. In conclusion, we have strong potential ahead for both Canada and the US.